All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas and today we're going to be taking a look at ticker ASO, American Sport Outdoors. Another company in kind of the retail recreational sport space. We have covered a couple companies in this area before, both Big Five Sporting Good and what's it called, Dick's Sporting Goods as well as some other tangentially related businesses, some other special line retailers, Hibbett Sport, for example, the company that we covered very recently. They're kind of a little bit of a close competitor in some ways as well as you can kind of compare them to other companies that at least manufacture the products that they are retailing. So that's technically a little bit of a similar peer group, at least in the kind of discretionary retail sort of sense. So before getting into the company, kind of taking a look at our watch list as is. Speaking of Hibbett, I did actually start a position in that today. It is pretty high up in the listing of companies on the overall value scoring for our watch list. So I decided to go ahead and take a small position in that. It'll definitely be a slow build up. Hey, how's it going, Evadors? Welcome to the stream. But anyway, as I was saying, so I'm definitely excited to do American Sport because it'll kind of fit with some of the other companies that we've covered. As I was saying, Dick's Sporting Goods, I think it's down here somewhere, as well as Big Five Sporting Goods, but I think it's much further down the list somewhere in here. As well as, like I said, they sell a lot of outdoor retail stuff, so I think they kind of overlap a little bit in the kind of at least investor spaces. Some of the gun manufacturers that we've also covered as well, like Smith & Wesson and Stern Ruger, both of which I'm interested in covering in the somewhat near future, so kind of pay attention to that space. But anyway, after this particular company, I'm also thinking that the next one we're going to cover this week is looking to be Sleep Number, though if something caught my attention relatively quickly, that could be replaced. Maybe Sleep Number could be pushed off. This isn't really a hard list per se, but that's kind of what we're looking at. So anyway, we will get into the valuation I put together for Academy Sport. Don't pay any attention to this necessarily. We kind of haven't really done everything on the numbers. I put in a lot of assumptions in the numbers. As I said, I'm kind of trying to cover all of the historical data before starting the streams nowadays, so that we can kind of get straight to a lot of the meat of the analysis and the future projections. Either way, they're kind of part of the retail special line space, which similar to the last few valuations did, means an unlevered beta of 1.09 and a sales to capital ratio for the industry of 2.99, an adjusted net margin of 5.77. They do operate all in the United States, so we can use just a US equity risk premium for them, which brings our equity risk premium currently to 5.99. They have a debt to equity ratio of about 51 to 52%, which brings their levered beta up to 1.56 after adjusting for taxes and interest rates. So which that brings their cost of equity up to 12.15%. That's on the back of obviously the treasury that we currently have as well. So pretty decent cost of equity there. The weighted average cost of capital comes up over 8%. That's on the back of the interest rates that they have, about 7.5% on the net of it, which is mostly just the lease liabilities for them. They don't actually have a lot of listed debt or credit lines per se, but it is mostly just the lease liabilities, which comes to a weighted average maturity of 9 years, which is pretty decent. But at that interest rate, yeah, 7.6%, it's not amazing interest rate at all. So that's part of the reason that their cost of equity has to be a significant premium above that. So anyway, the company IPO'd in late 2020 or mid to late 2020. So there isn't too much historical data to really look back at it, including both the information that they release on their first 10K as well as the filing for registration release that they have. I was able to get numbers back to 2018 with some small extrapolations involved with that. But either way, you can kind of see that this is really the total history that we have to look at. It's not really a whole lot, but they do have some other things that we can kind of take into account. We can see that from 2018 to 2019, their sales was basically flat, but then they had a pretty solid growth in 2020, which is pretty interesting considering that they would have been shut down for the first half of it. So obviously the big boost they got in the second half was enough to completely counteract that, which is pretty awesome. And then they did have also almost 20% growth in 2021 as well. So obviously the more complete release of from a lot of the shutdown stuff meant a lot more experiential retail was definitely getting the big boost. Obviously everyone's been talking about that, and whether they didn't experience too much of the inflationary pressures in 2021 themselves. But the real question obviously is what's going to happen with that moving forward, as well as the fall back against general discretionary dispensing as the potential for economic slowdowns come into play. So we can also take a look at their gross margins over the period. The gross margins were moving up just as much in line with the revenues. So that part might also come down pretty significantly moving forward, but at the same time, that part is possibly a result of them actually gaining share against their competitors, but it's a little bit more complicated than that. We will get into their presentation a little bit, and I'll give some of my thoughts on a little bit of that. Their overall net margin was very, very low in the 2019 and 2018 numbers. So we can maybe chalk that up to being some of the excess costs that private companies have relative to public companies, because public companies definitely have just different dynamics on the whole. Not to mention they are preparing for going public, so it's kind of hard to know whether or not these numbers can actually be taken into account necessarily. But either way, kind of still choosing to take it into account regardless. You can see that while they have almost 10% in margin in the most recent year, it's really like 4.5% if we include all 4 of those years. If we only include 3 of the years, it's 5 to 6% or so. I can come down here, I guess, to the corrected line. It's really the same number. I'm actually choosing to use the 2-year average, which is 7.5% or so. Making one lay down. As a little bit of a base, basically on the premise that their margins will drop down a little bit in the next year, as some of the sales probably do take some slowdown. They're not necessarily taking a huge hit on that. We'll actually assume that it comes down a little bit more over time as we move forward with that. The few years worth of cash flow that they have to look at, you can see that they haven't really been overpaying their shareholders, which is pretty good. But obviously that kind of comes with the fact that they were IPOing in 2020, so there's going to be a huge negative outflow from the shareholders that existed previously to that. But even with the 1 year that we have in total since their IPO, they did do quite a lot of buybacks pretty much immediately right out the gate to counteract the IPO effectively. But they didn't overpay their shareholders, at least for that 1 year. And then they did also start a dividend, a relatively small dividend, but it is got lots of room to grow, I guess you could say. Also taking a look at the effect of their cash flow on their capital, the return on invested capital, even during those previous years where the margins were extraordinarily low, still came in pretty good. Obviously the 5% is not super great, but the 16% was on the lowest of the margin years. So I would say that even the average between them being about 10 to 11% is pretty good. The average over all 4 of the years being about 15%, and still about 15% for the most recent 3 years. And then the return on equity being significantly stronger than that, so their usage of the leverage that they have, which is pretty significant amount of leverage, does actually seem to be benefiting them pretty strongly. Taking a look at their balance sheet, you can see that the current assets have improved or increased pretty significantly, but so have the current liabilities. In fact, the current liabilities have increased to a larger degree, and the overall assets have also basically kept with that similar trend, where they've increased about 30% or so, while the current the total liabilities have increased more like 40 to 50%. So still a larger increase in liabilities relative to the assets. But as we had already shown with the cash flow, the returns on invested capital and the returns on equity are still sustaining that growth. So really that's a good form of leverage, it seems. Moving down the line to the sales to capital ratio calculation I have down here, over the 3 years, or over the 4 years that we have in total, they have an average of 2 to 3 or so as a sales capital ratio, but there's kind of this somewhat of an outlier of a 6 thrown in here, so it's a little bit thrown off. 3-year average is just under 2, and 2-year average is just over 2. I am using the 2-year average as our baseline year moving forward, which is a little bit lower than the most recent year, so I think that is a decent kind of conservative way to approach it. So with that, we can kind of actually take a look at the assumptions that came in. I think there was a weird thing kind of coming through the calculation from Google Finance before, because it shifted the cost of equity down, and you can see that the value shifted as well. There might have been might have been bringing in a weird calculation for the end of day number, which could have been throwing off the market cap, which would have then thrown off the debt to equity ratio, which would have then thrown off the cost of equity. So if anybody's wondering why that switched, that's probably what happened there. Pretty sure this is closer to the more accurate number. But anyway, I digress. So with the debt to equity ratio, because of the fact that most of their liabilities are lease liabilities, we can assume that it's possible that they actually could pay down the majority of them and not reissue new lease liabilities in the coming future, but that's not necessarily super likely. So we'll probably leave like maybe a 10% in the best case scenario for their debt to equity ratio. And for the worst case scenario, we would assume that they would probably increase their debt pretty significantly. 120 is maybe a little high. We'll leave it maybe at 100 or something. That brings the expected level to 50%, which is a little bit lower than the current level. So maybe I'll go back up to 110 or 120. That brings the expected value to 54. I think that's pretty decent. We're gonna leave the analyst number. We'll maybe bring that up to 50 as well. Yeah, 56. Okay, I'm okay with that assumption. Okay, so moving up the line to the sales to capital ratio. As I said, we were using the 2-year average as our baseline year, and we're kind of going to coast towards a relatively similar number in the future, with the median being slightly lower than the expected value. Expected value being 2.22, and that's basically in line with the 2-year average. So I do think that they can maintain basically about the same sales to capital ratio. And then with that, we'll also look at the margins. This is definitely where a lot of the valuation falls, where you think their margins will go, because obviously they have this close to 10% margin currently. And so if you think that they're going to get close to 10% margins in the future, well, then they're going to be way more valuable than if they fall back to, as we were saying before, the 3 or 4 year average, which is more like 4 to 5, maybe 6%. So I have my expected at about 5.5%, which gives us an expected range of 1.5 to 9, with 5 being kind of the analyst pool number. So I think that's a pretty decent range, and that goes kind of in line with, again, the industrial expectations for experiential retail, which gets us a 5.77% industrial number for the most recent year. So they did better than their industry in the most recent year, but we're assuming they're going to go back down to where their industry was in the most recent year. And the industry itself will probably have decreasing margins, but they'll probably still maintain a better lead relative to their peers. I think it's just that's where it's going to go. So I think this is a pretty decent expected margin to use, but that is definitely where the crux of the valuation falls, and the overall effect of everything is gonna fall on what kind of margins you give them, because the sales is going to make a decent dent, but at the same time they have such a good sales to capital ratio that they can maintain a good value even with relatively low sales growth or even negative sales growth. So with that on sales, kind of doing it last is a little bit of a weird backwards way, but it's kind of the way we're approaching this one. Is we do have worst case scenario. I'm seeing, well, actually I should start with the base year. I'm using the 3-year average as the base year for our current expectation, and that's sort of on the back of a lot of the expected numbers coming from both the analysts and the company itself. Let me actually pull that up. Now, 11 analysts are projecting negative 0.5% to negative 1% or so decline in the next most recent year, and we can kind of compare that to a lot of the negative sales growth that's on the expectation of a lot of the other retailers that we saw. And so I'm kind of in the more bearish side, I guess you could say, of their current next year, but while seeing a better potential for the future years after that. So I actually see more like a negative 3 to 4% for possibly the next most recent year, and then analysts are seeing a bounce back after that. I do think that that's potentially a real possibility, but I do want to take into the potentiality that this next year is going to be a little bit of a decline. And then if we get into the presentation that they gave themselves, you can see that they are doing really good on their per sales store metrics. But let me see where they had, I think it was actually further up in the line. Where is it? Oh, maybe I did pass it. Or maybe it was in the outlook over here. Oh yeah, my bad. This is what I was looking for. Their fiscal guidance that they had in the report they gave for their Q4 numbers. They see comparable sales on the low end of being -4% and on the high end being -1%. So I'm definitely more in agreement with the company itself than the analysts. So I'm seeing maybe like a 3 to 4% drop the next year. Hey, how's it going? Welcome to the stream. If you're watching the stream and you're enjoying the content, it would be really appreciated if you could like it. We're definitely trying to grow the channel, and the more likes I can get, the easier it is to attract more viewers. So that would be very appreciated. But anyway, so as I was saying, I'm going to use the 3-year average of the most recent year revenues as the baseline assumption of what we think for the next year's revenues, and then with that we're going to then have a worst case scenario of -4% with a best case scenario of +5%, so slightly tilted towards the positive end, but from that negative base year. That means our expected revenue effectively for the next year comes out to 5.8 billion versus the 6.7 billion this next year. So we're assuming a pretty rough next year for them, and that kind of has a pretty big effect. Thank you very much. That has a pretty big effect on the numbers to a certain degree, because if we move it to the 2-year average, which brings it more down to a $500 million drop in the revenues, that kind of brings a little bit more of the revenues up. So that was one of the things that I had that in there from what I was looking at last night, but I was kind of going a little bit back and forth on it. I might go ahead and just let it be the negative, the 2-year average, which kind of brings more of a -3 to 4%, which is in line with the company was expecting themselves. But then with that means I might adjust some of these numbers, because that brings our expected revenue for 4 years thereafter to 6.4 billion. I actually think it could maybe be a little bit lower than that. So maybe I'll shift these numbers or reverse them to where they were. But then I'll shift the probabilities as well. So it's kind of a little bit of a back and forth with where we expect numbers to be. Okay, so that brings our expected revenue for 5 years from now to 6.1 billion versus the 6.7 they currently have. This is definitely being a little bit on the conservative side of things generally, but that's kind of generally how I look at things. If we kind of were a little bit more optimistic on the revenue potentials for them. Hey, how's it going, man? You can see that it does also increase the revenue, increases the value a little bit, but it's not necessarily a huge amount. I mean, I don't know how much revenue growth you can, even a relatively bullish person would see on them. It does increase it a bit, but it doesn't have like it doesn't turn it into like the greatest investment of all time, that's for sure. I don't know, 6.2 maybe I can kind of like let it be relatively flat after this down year on the years after that. Most of the probabilities are weighted into the middle line of that, so that leaves the expected net margin at 5.5. And the sales to capital ratio still in the 220s or so. The only thing left really, I think, to adjust at that point comes down to maybe the interest coverage ratio, unless there's more things we want to adjust. We can see that the in terms of invested capital, the base that we're using is the 3-year average, which comes out just under 15%. With the assumptions we put in, that brings their returns on invested capital that they would have 5 years from now down to 12%. So it does imply that we are seeing their returns on invested capital drop. I don't know, maybe 2%. We can maybe bring the worst case scenario margin up a little bit. That's actually one thing that maybe I could pull up. That brings the expected value slightly up, but not too much. Yeah, I was trying to think about, maybe I'm being a little too harsh in some areas. That could be one area. 2% is a worst case scenario. I think it's still a pretty large down decline. It comes down to basically where they were prior to IPO. Yeah. But the last thing I did want to say on their presentation, though, is as I was looking for the comparable sales numbers that they had in their guidance, they also do have these sales per store numbers. Unfortunately, the industry, the record of their financial numbers is so short that it wasn't really worth trying to put together a huge revenue growth model, because I can't really analyze their sales numbers over a longer period of time. But it is interesting to see that, at least according to them, the sales per store is so much higher than the other 2 sport retailers that we've covered on the channel, as well as the foot and shoe retailer that and athletic retailer that we had covered most recently, which I personally think that this one's not super comparable compared to these 2 in Academy. Like these 3 definitely belong with each other much more solidly. Like this one I would compare much more with other shoe retailers personally, but I can understand why they include it a little bit. but also the sales per total square footage that they claim is also have improved on that. Tomorrow, Valvoline. I bought a little bit of Valvoline today. Not a lot, but I did add a little bit more today. Alongside, I did start a position in Hibbett Sports literally just today as well. So just in case anybody's wondering on that. But yeah, so I definitely think that they have a pretty strong competitive position, at least on the efficiencies of their stores. So with that, we can kind of move on to the default risk, which actually I just realized I did not pull open the worksheet that I have on that. There we go. Yeah. So let's adjust for defaults and take a look at the perpetual debt loads that we are kind of projecting for them 5 years from now versus the total cash flows they have now. I don't really see them as actually paying off the total debt in any of these scenarios. So we'll actually use the numbers on this chart for determining the default risk, which let's see what that does to their value. Hopefully it doesn't take off too much. Yeah, I thought I saw some upward movement on KBH as well. I haven't looked at the other ones as closely, but you know, PATK is on our short list, so we may be valuing it sometime in the near future. But yeah, curious to see about that. I don't know the reason why necessarily. You know, it could just be that it had gone down too much and so some shorts were getting out or something. But always nice, always nice. Okay, yeah, so that definitely trimmed off a decent amount of their the value by taking into account the risk they have on the debt loads. Definitely a major feature to keep in mind. So I mean, this is pretty much what we're looking at with that ticker ASO. Academy Sports and Outdoors. The US Treasury selling for 2.8% or so. Mature market equity risk premium I currently have is 5.13%, and that brings it up to a discount rate for ASO of 10.81%. They currently have a dividend of just under 1%, a pretty small dividend, but I imagine it will grow in the future. They have sales most recently of $6.7 billion and a sales to capital ratio of 2.23, which is a little low relative to the industrial expectations, but nothing too major. That overall it's still a relatively high number in an absolute sense. Returns on invested capital for the last 3 years on average has been 14-15% or so, and debt to equity ratio currently of 51%. In the most recent year, the default risk has been just over 1%, nothing too major. And profit margins on the last 2 years on average has been 7.5% or so, compared to the industrial expectations of 5 to 6%. So they do have a relatively small sales capital ratio against their industry, but they do have a slightly higher margin, which is you know, pretty strong position to generally be in if they can keep it. That gives them profit in the most recent year of $671 million. They're currently selling for $39.72. We have a probability distribution, which is pretty heavily weighed into the middle outcome, but we have it slightly tilted towards our fourth model, which isn't necessarily to mean that it's overly optimistic. We have a lot of the numbers, I think, conservatively measured backward on that sense. But either way, that gets us to a revenue projection of anywhere from 4.8 billion to possibly 7.9 billion on an expected basis. We see 6.3 billion, which comes into sales growth of -1.5% or so. We have a sales to capital ratio expectation of about 2.26, so we assume that it's basically going to stay about the same as they currently have. Now, returns on invested capital, we see them decreasing on an expected basis compared to where they were in the most recent few years. And debt to equity ratio, we assume that they're going to increase it a little bit, either because their market cap comes down in the short run or because they do actually increase their debt loads. And on that top of that, we do assume that therefore they'll have a little bit more default risk. That definitely is trimming away a decent amount of the value on them. So if you definitely think there's less default risk, that can kind of tailor your views on the overall valuation. We do have a profit margin distribution of anywhere from 2% to 9%, which gives us an expectation of 5 to 6% or so, and that gets us a profit expectation of anywhere from $96 million to, in the worst case scenario, to possibly $716 million in the best case scenario. We see 358 or so on an expected basis, which is a pretty significant drop from the most recent year of profit. But that explains part of the reason why they're trading at such a cheap multiple. It's because everyone assumes that the earnings are going to adjust themselves over time. And we do have an expected present value price of $40.97, which is 3% higher than the current share price. Our 5-year forward value targets, unadjusted for the dividends that they'll pay out, is anywhere from $18.04 in the worst case scenario to possibly $158.86 in the best case scenario. On an expected basis, we see $68.46, which if you compare that to the current share price and calculate back at a yield to maturity, that gets us an implied return of 11.5% per year for the next 5 years. So which is, not a shabby return at all, but it's only a little bit above its discount rate. So, it basically means that it's, in risk adjusted terms, only barely better than just buying the market. Even though the absolute return will be better than buying the market, it just means you would have to deal with the volatility and the risk associated with it. That's what that means. So, 11.5%, like I said, is not a bad return in an absolute sense at all. But not high enough that makes me definitely want to make a huge jump at it per se, as well as the value score, which takes into account a lot of qualitative factors, including the sales capital ratio, the returns invested capital, and the profit margins. Kind of weighs them in a little bit more according to my own liking. It gets me a score of 0.78, which is above the general score of the index, but it's definitely not putting it into the upper levels of scores, which is generally like above 1 or something when scores start to look good and enticing to me. Just for comparative sense, like I said, I just bought some Hibbett today, and the value score on that one I think is like 1.16 or something. So at least according to my personal little value metric that I use, it was a significantly better buy than Academy Sport, even though, like I said, 11.5% is definitely nothing to sneeze at. Short-term pricing metrics, which is based off of multiples and a regression against them, implies a price way higher than it currently is, but that's because again, the multiples are really low. 5.3% PE, or 5.3 PE, 2.3 price to book, 0.5 price to sales, 4.9 EV to EBITDA. So people who are looking at multiples will definitely think that Academy Sport should be priced way higher than it currently is, if they're comparing it to just the general multiples of the S&P 500, which is kind of what this little section down here is doing. So yeah, I'm definitely going to be passing on this one, but as I had said at the start of the stream, I was very interested to add this to the watch list just because we did have other companies that were so comparable already in the list, such as Big Five Sporting Goods and Dick's Sporting Goods. We did have those two competitors of theirs already valued in here, and one or both of them might be about due for a new valuation at some point in the near future anyway. So definitely gonna have to take a look at that. It's a very small starting position. It's only like 0.5% of my portfolio as a start, but it'll build quickly. It'll build quickly. All my positions always get to at least 1%, but I imagine Hibbett will go to like 3 to 5% or something. That's pretty typical position size for me. But I start slow. I always start slow and nibble on for a month or two, unless it goes up really quickly. So assuming Hibbett doesn't skyrocket anywhere really quickly, it'll definitely grow much bigger. But as a start, it was really only about like 0.5% of a position. So it's a small little starter position. Because I'm hoping it goes down, over the next month or two. That's how I approach. I always like to buy and sell things on kind of a slow basis. Even when I'm selling a position, I usually sell out of a positions like over the course of like a month or two. It's like I'll sell a few shares this day, and then the next day where I'm buying shares, I'll sell a few more shares, and then I'll sell a few more shares a few days later after that. But because sometimes it keeps moving up, and I kind of look at it as like a supply and demand kind of thing, where if I'm in the buying position, I try to buy things on the days where it looks things can move up with that way, and then when I'm selling things, I try to kind of sell things when the demand is high. I'm right there with you that there's definitely some potential for it to go up in the short term. So that's a risk. That's always a risk I take when I take a small nibble like that. Sometimes I'm very dissatisfied months later when I find out that when a stock has skyrocketed and I've only gotten a small position. That happens to me all the time, but I prefer that over putting all my money in and not being able to buy in. Like a good example of that is Facebook, for example. Like when I started buying into Facebook, it was much higher than it currently is, but my average price on Facebook is not bad at all compared to where I started buying, because I started buying small and I've been able to buy into it pretty well as it's come down this level. So that's just the approach I like to have. Other people take a different approach. I used to do it differently. I used to basically just like go all in on a position on one day and then sell out of the position all on one day. But I kind of moved away from that and just kind of have this idea where it's like I would rather dollar cost average into a position and dollar cost average out of a position at the same time. Like those are, I think, both useful ideas. So that's just me. But yeah, I mean, we'll see what happens with Hibbett. It definitely, it's pretty highly shorted right now. So, you know, if some shorts decide that the times to get out is now, and then it starts to unwind that way, it could easily be 30% or 40% higher than it currently is right now. Who knows? How much have I sold from WBD? Not a lot. That's a good question. I'm not really sure. Let me see. From the whole position, I mean, let me see. How many shares have I actually sold? Not a lot. I haven't sold a huge amount, but I've sold about 10% of my position on it, and I'm probably gonna sell at least half of it before they release numbers. But at that point, I'll probably stop, because like I said, I had increased my exposure initially at the start of the deal, because I was trying to get excess shares of it, but that was kind of like a short-term deal move that I was operating, and so now I'm kind of unwinding a position a little bit of it. So I've definitely I've sold like 10 to 15% of the shares that I received, and I'm probably going to sell about half of them or something over the course of the next month or two. So that's probably the position with that, and I am selling out of a decent bit of AT&T with it as well. You know, like I said, I built up the position on both, and so it's kind of like I'm trimming back both of them to get them much smaller, because they're both just larger positions than I would like them to be. Not that I think that they necessarily have bad returns. You know, it's not a valuation thing. It's a capital and portfolio management thing. Just so we're clear of why I'm selling WBD. It's not so much that like I actually think that they're, you know, a bad deal per se, but that's just how it is. Some earnings, actually I wasn't paying super close attention to that. WBD, are they releasing their earnings tomorrow? Is that what's happening? I honestly often am not necessarily super pay attention to earnings until they happen. I often only find out like when it happens. Let's find out. Is that what's happening? Oh yeah, well, certainly says that according to Yahoo. I was looking on their website a little bit earlier on some of their forms, their ownership forms, so we'll see about that. But yeah, so I mean, like I said, it's definitely not like I'm not bearish on them or anything. I just have too much of them compared to the amount of risk I want to take on them. So but I do think they're undervalued. We'll see what their earnings look like. The earnings aren't going to have anything to do with the deal, you know. So that's like one thing you kind of have to keep in mind, is that like this earnings that they're going to report is going to have none of the Warner Brothers numbers in it. In fact, all of those numbers will basically be on the AT&T side of the numbers for the first quarter. So we're not really going to know anything that's like super useful about Warner Brothers and the deal specifically for another 3 months. That's kind of the thing. So that's why it's like, even with this quarter, it's not necessarily going to give us like a whole bunch of information. The only thing that's going to be useful to it is that the earnings call will be able to, the analysts will be able to ask some questions probably about those plans. So the call will be interesting, but the numbers that they release are not actually going to be really all that helpful. Not for trying to figure out what they're worth in the future, you know. So there is just that to keep in mind about that. But either way, thanks for bringing it to my attention though. Like I said, I'm often kind of too busy looking at one thing or another, and then I find out that a company of mine reported earnings because I see a headline. Like I'm often very slow to pay attention to that. I pay attention to when the 10Ks come out. See, like I pay attention when the annual reports are being reported, but like the quarterly ones, I'm often like, oh yeah, I didn't even realize they're reporting this week. Like I'm gonna be like that. I'm often too focused on looking at the next company. to pay super close attention to when my companies are reporting. But sometimes I think that's a good thing, though. You know, it can be a little bit too close. And I definitely don't listen to every earnings call that all my companies put out. So I definitely don't. I listen to at least, you know, the ones that when I'm doing the valuation, but which is usually around the 10K. So I usually listen to the fourth quarter one, but unless there's like a specific something that I want to hear from the management, I often don't necessarily pay like that close attention to my companies. I don't know. But you know, different people have different approaches to it. But I think I'm a very numbers focused person. I try not to let the day-to-day stuff of the business necessarily distract me too much. But you know, different things on that. So either way, before ending the stream, and we're only 35 minutes in, but you know, we kind of change up the format to do the evaluation a little bit more up front. I will, as I was saying at the start of the stream, I am taking a look at Sleep Number as probably the next one I'm going to be covering at the end of the week. And so I was kind of already taking a look at some of the numbers in the presentation. We can kind of like look at that a little bit. They've had a pretty significant sales growth for the last several years. I like that they at least include this in here, so I don't have to go through all their reports and actually get an idea of all these details necessarily right now. But pretty strong sales growth, though that does include obviously the growth that came off the back of 2020 and 2021, which is very significant. But they do have pretty significant expectations moving forward in their own guidance, which is one of the things that's very interesting about this. You can see right here, the 2020 EPS outlook is 10 to 15% higher than 2021, so that's pretty impressive. The returns on invested capital have also been growing pretty significantly over time, which is generally one of my favorite metrics to care about. And then where was the here, and their 2020 guidance that they have in here, which this presentation came out only, I think it was like mid-March, so it's not a very old presentation at all. Low double digits on mid to high single digit demand growth for net sales 2022. They're projecting double digit growth in 2022 amidst all of the stuff that's going on. It's like, and again, this came out in March, so it's like, wow, they have pretty high confidence, I guess, in their ability to meet shipments in the middle of all of the supply situations we got. So I don't know, low double digits. Assume they fail that. Assume they get high single digits. You know, that's still pretty good for 2022. Like in this year, that's not bad at all. And then 2023, 2026, they have their kind of guidance numbers in here too, which is always nice when management gives you kind of like a longer term guidance, because I much prefer to go off of company guided numbers than analyst guided numbers personally. So that's it's very nice when you can get like some longer range targets and not just the 1 year after. Like, companies are, you know, typical to give you the 1 year after, but getting a little bit more than that is also always really good too. So either way, I did like that they give the specific guidance across the board, but it all looks very strong, and it's like, wow, either they're delusional, or Sleep Number might be the sleeping hero of 2022, which, you know, I mean, I've seen it on the Magic Formula website for some time now. I've seen a few other value investor YouTubers that have been making content about it, and viewers of this channel have been kind of poking it at me for some time. So obviously, like, a lot of people have been driving their attention to it. But either way, yeah. So I'm definitely excited to kind of take a look at this one. As I said, that's definitely what we're looking at for the stream on Thursday, probably, unless anybody has some greater recommendation that would pull my attention away. But yeah, so that's kind of what I'm thinking. Also, I have been doing a lot of work on my new template. Let's kind of see the bare bones of it right here. It's a lot of work. I mean, not really much work at all, but really just kind of trying to figure out the maps. This is the thing. It's like putting together a spreadsheet template like this. Like, there's a lot of things in it. They kind of have to all work together a bit like an engineered product. So you kind of have to like understand the blueprints of it all before you start putting it all together. So it doesn't actually look like a lot right here. Just kind of like laying out the basic like groundwork of the financial statements, but that's basically what I'm doing, is just kind of laying some blueprints in place. But we are trying to work on that. I know I've been kind of like promising that on the channel for quite a long time, but trying to get some progress on that. So either way, that's pretty much going to do it for the stream today. As we've kind of been talking about, we expect a Sleep Number on Thursday. That's definitely what we're looking to do. There should also be another produced video that I'm going to be releasing hopefully this Saturday. I'm trying to release some I produce content every other week alongside these twice weekly streams. Thank you for coming to the stream. Thank you for your comments in chat. I appreciate all the participation. I appreciate the likes as well. I've definitely been getting lots of good views, lots of subscribers, lots of likes. I'm definitely appreciating the love. So yeah, Thursday around the same time, 2 or 3 p.m. probably 2. It's usually 2 on Thursdays and 3 on Monday because of my because of my school schedule. Although my school semester is going to be ending after that. After Saturday. Yeah, because it's stream on Thursday, video on Saturday, and then Monday stream. It's like Monday, Thursday streams, every other Saturday for video. That's the schedule. Twice a week, Monday, Thursday streams, videos every other Saturday. So catch you all next time.